Today I'm joined by Paul Clark, who is Head of Stewardship at UBS Asset Management. Good morning, Paul.
Good morning, Rob. Thanks for joining.
Thank you. Now, for the audience, could you please explain to us what stewardship is and how it's evolved?
Yes, of course. So the term stewardship is often referred to as responsible or active ownership. And it's really become more prominent since the first stewardship code was introduced in the UK back in 2010. Other countries have followed since then with similar codes, but that's led to a much clearer definition of what stewardship really is and why it's important. And the revised UK code, which was introduced this time last year, is by far the most reaching of the codes that we see globally. And I'm going to try and give you the full description of what the UK code says here, so bear with me. But the UK code defines stewardship as the responsible allocation, management, oversight of capital to create long-term value for clients and beneficiaries, leading to sustainable benefits for the economy, the environment, and society. Now, the first sentence there, Rob, is key. The responsible allocation, management, and oversight of capital. Okay, it can be very easy to forget that for most investment firms, we manage other people's money, and we are responsible for the outcomes of that, both from an investment return perspective, but also in relation to how we meet the values and expectations of the end investor. 30 years ago, it was, here's some money for you to invest. Please get a great return for me, and then return to the fund. The way people invest is changing. Investor attitudes are changing, as are regulatory requirements. And there's a clear expectation that there is a part of fiduciary responsibility to monitor investee companies and play a part in ensuring that those companies are well run. And that should be for the benefit of shareholders, employees, and ultimately wider society. So while stewardship was initially regarded as being a combination of corporate engagement and voting, essentially that has moved on, and stewardship is now no longer a case of having a separate stewardship function within a separate team to manage a particular process. Stewardship and engagement are now tangible drivers of change, and effective stewardship is now an intrinsic part of the investment decision process. Essentially, it means looking after the assets entrusted to you in everything that you do, from the culture of your firm to ensuring that your investment decisions are made responsibly in the interests of the end beneficiaries, to driving positive improvements by using the power of the vote. And that is essentially what stewardship is. It is embedding that oversight and ownership and management of assets in everything that you do.
Thanks, Paul. That's a great explanation. And I think many people out there that have had this or touched on this subject probably appreciate your view there. Now, you mentioned it's evolved since around about 2010. What do you think we can expect from future stewardship codes?
So there's a number of different discussions and developments taking place, and I don't think we can cover them all in a short discussion. So I'll focus on and highlight two in particular, Rob. Firstly, a clear requirement for improved transparency on the part of investors in relation to their stewardship activities. So what actions they've taken over a relevant period, and importantly, what are the outcomes from that activity? Previously, it was okay for an investor to have a nice policy explaining their approach to stewardship, and regulatory requirements like SRD2 still form the basis for that in terms of saying to investors, you must have a policy, it must be public, it must explain what your approach is. But the developments go much further than that, Rob. And the developments extend not only to asset managers, but importantly to asset owners, who have a requirement now to monitor the activities of their chosen managers and take into account the activities of their managers through the manager selection process, and then to report to their end beneficiaries on how they monitor those managers and why they choose their managers. And that changes the market landscape completely. Investors, for example, who wish to remain signatories to the UK Stewardship Code have to now report both to their clients, but also with a public report every year on those, explaining those actions I mentioned and how they meet the 12 principles of the UK Stewardship Code. And that annual report needs to be public. It's not just sufficient to go to your clients, and it needs to be global in nature. It needs to cover not just only equities, but other asset classes. It needs to cover fixed income. It needs to cover alternative assets like direct investments, for example. And again, that's a sea change. It's not simply engagement on equities. It's engagement on equities in every other asset class. And what was the outcome from that? What did you do? What came of that? What was the benefit to your clients, and what was the benefit to that wider society that I mentioned? And importantly, that report needs to go into enough detail to allow the reader to form a clear view on the actions being taken. This is not a marketing report. This is an actions report. And it should be approved and endorsed by the most senior body of your firm, essentially giving an approval and a commitment from the business to stewardship. And the second aspect, moving beyond the reporting side and transparency, is around the topics that investors are now engaging with companies upon. And corporate governance has long been the topic that most people are familiar with, whether that's executive compensation or whether that's board structure. And those traditional topics will continue to be part of those everyday conversations that investors have with companies, and quite rightly so. But the topics are changing, and the dialogue on those crucial topics now includes topics such as the company's purpose, how the business strategy maximizes returns for all stakeholders, not just shareholders, and that whole shareholder primacy is being changed. So how does the company take into account all stakeholders? How do they support their workforce? If you think about COVID over the last year, what have they done to support their employees and continue the sustainability of the business? How do they set sustainable goals? How do they include targets for managing environmental risk? And how does the board manage that risk, and how do they set the strategy around that? And that's a movement away, not just from the traditional governance topics, but it's the inclusion of those governance topics. And these are all among really the key areas, Rob, that investors are now raising with companies. And those two topics, I think transparency and the changing topics and the changing landscape of what we discuss with companies, is really where we're seeing the biggest drivers for change at the moment.
That's really interesting, Paul. You mentioned earlier on sustainability, which is one of those buzzwords that's been going around now for the last 2 or 3 years. And obviously the biggest, hottest topic, I think, on everyone's agenda is ESG. Where does ESG fit into all of this?
Well, I think you describe it very well, actually, Rob. So there's a lot of acronyms in the market, and lots of different descriptions for essentially a very similar and linked process. So there's ESG, there's SDGs, there's impact, there's stewardship, there's SRI, there's sustainability. And I think all of that description for somebody not familiar with that can be quite confusing. And when you put yourself in the shoes of a trustee of a pension fund, for example, when they have different managers describing things in different ways, that can be a challenge. And the market has some work to do to help improve the understanding of what this really is. And for us, we have defined a very clear approach here at UBS, and it's around sustainable investing as an overarching concept that covers all of those different terms. So it's not just focusing on ESG, it's sustainable investing. And ESG integration is centered on essentially taking into account non-traditional extra financial data alongside the traditional investment financial data that you have. So essentially overlaying the regular financial analysis performed with ESG specific data so that we can identify any risks or opportunities. Okay, so ESG analysis is reshaping the investment landscape. It's gone from being a nice to have to a must have. And a growing number of investors have come to recognize the benefits of including those ESG considerations into the investment process from a performance perspective. This is a performance-driven integration of ESG. It's not a standalone process. And our approach, for example, is to first create an ESG, proprietary ESG risk signal for each and every issuer. And of course, there are third-party firms that do that as well, and I won't go into naming them, but there's lots of different firms out there around ESG data. But what we've found is that the methodologies can be different, and ESG views and beliefs are different. So we've created a proprietary score around that, And our fundamental research teams then take that proprietary score and overlay it with their traditional financial analysis. And what they're trying to do is, and what they're aiming to do, is to look at the topics we've identified as risks and opportunities, and then see if they agree with the risk signal. And if they don't agree with the risk signal, challenge that signal. So it's not a binary score that we apply, it's a score that you start with, and then you move on from there to include the risk and opportunities into your financial analysis. And it's then those ESG factors that form the cornerstone of our discussions with companies. So it then gives us those topics to focus on with companies, and it forms that dialogue that takes place. So it's in addition to those traditional business conversations we have around strategy and financials, we take those financial and ESG topics that we've identified, and that's what we engage on with companies. So that ESG fits into the whole financial analysis process and then informs your conversations. And you don't want to have a standalone conversation with a company on financials and a standalone conversation on ESG. It wants to be one conversation. It wants to be a strong, overarching discussion. And companies really value that. There's thousands of investors all want to talk to companies, and the messages they give to companies can always be different. And that's rightly so, depending on the investment strategy of the firm. But companies get mixed signals, and it's important that companies get an understanding of why you're discussing these issues with them and what they can do to change and what best practice you've seen that helps those companies. And that ESG factors, the ESG factors I mentioned, absolutely drive into that. And companies need investor support to understand what they should be thinking about and how they should be driving change going forward. And it's very important to remember that, particularly in the UK, many investors now choose to invest via index tracking or so-called passive investments. So they don't always get to choose the companies they invest in, and they can't always walk away from the companies they may not choose to want to invest in. And if I go back to the definition of stewardship around ensuring that managers take into account the beliefs and values of the end investor, if you're an index investor and you're just buying the index, you want to know that everything your manager is doing around stewardship is aimed at long-term value. An index investor, by its very nature, is not a 3 to 5 year investor. They're a 5, 10, 15, 20, 30-year time horizon investor. So they want companies to be sustainable now and be here in the long term. So integrating those ESG factors in the conversations you have as both a passive investor and an active manager is critical. It's the only way to balance out the different investment horizons and different time horizons of different investors.
Thanks for that, Paul. I think the audience will look at this and hopefully understand the huge responsibilities that you have as an asset manager and conducting that clarity with the companies that you're investing in. So no, thanks for that. One last question for you, and obviously it would be remiss of me on a securities finance webinar series to not ask this question, but does all of these policies affect your securities lending program?
Stock lending is obviously got a different focus in the market depending on who you are, Rob. So it can obviously be very positive, but it can also be focused on in a negative way. And it can receive occasionally some unwarranted negative opinions. But stock lending can be beneficial to a fund or a portfolio by providing an additional income stream. And to the market, of course, by providing additional liquidity. But not all, when we look at us, for example, not all of our funds have a provision for lending, but quite a few do. And it's very much dependent on the client or the fund to determine whether lending is the right thing for that fund or whether it isn't. And there is a trade-off. There's no doubt about it. Particularly when it comes to, for example, exercising voting rights on lending positions. And when you look at stewardship, that's one of the key factors and the key impacts upon any particular lending program. And of course, voting rights are linked to equity positions. When you lend an equity position, the voting rights move from the lender to the borrower. And you ultimately don't have control over the voting rights. So that trade-off between that income stream that you want to receive, you think is beneficial to the strategy or the portfolio, is offset by the fact that you're giving away, if you like, some voting rights. But it doesn't end there, and I think it's important to remember that it doesn't end there. So through our process, for example, we monitor the loan positions that we have, and we look at the eligibility of the number of shares we have when we come to vote. And then we look at the nature of the vote that we have. So is it controversial? Is it likely to be really financially material to the end investment that we've made for our clients? Or have we been engaging with that particular company on topics that we really consider to be material? And if we have, then we'll take that into account and may look to bring the stock back from loan for the period of voting. But if we haven't, we're always going to be an investor in that company. And we're never going to lend 100% of the shares that we own. So we're always going to remain a shareholder. And we can always remain and exercise our voting rights on all of our position where we can. And of course, it's important to remember not all of our clients give us their voting rights or take part in lending programs to ourselves. So we don't always have visibility on what is on loan. So we take a balanced view. We look at the loan as part of the holistic investment return for the fund. We look at what's coming up on the vote, and we get all the engagement for that matter. And we take into account whether we want to recall the stock or whether we don't. And then we look at that in a holistic view. We look at the benefits of lending alongside the benefits of voting. I think there can be a balance between it.
Thanks, Paul. That's really interesting, and I think it's going to provide some clear direction to many beneficial owners in terms of what they're doing. They'll probably see a lot of similarities in what you're doing. And I think I should also say that in the last reporting round of the Stewardship Code, UBS did fantastically well as well. So congratulations there to you and your team that provided the report to them. I know you've done a huge amount of work around it and continue to do so. So thank you very much today for joining us.
My pleasure. Thanks for inviting me.
I'm sure a lot of people have questions, which hopefully you can direct through me and I can provide them to Paul. And we'll look forward to seeing you all very soon again for another episode to help beneficial owners with securities finance. So thanks very much, Paul.
My pleasure.
And thanks, and see you all again soon. Thank you. Bye-bye.
Thanks.